Recessions are outlawed. Why your dollar's purchasing power must always decline. Imagine waking up tomorrow and your dollar suddenly buys more. Sounds like a dream, right? But what if I told you this gift of deflation is actually a nightmare that could collapse our entire economy and won't ever be allowed by the government? So, here, of course, we're looking at the purchasing power of the US dollar going back to 1913. This is when the Federal Reserve, or the US Central Bank, was created. Then in orange, we're looking at the Dow Jones Industrial Average, which has been one of the major stock indices in America. What I want to point out is, of course, the trend here is very, very clear when it comes to the purchasing power of the dollar, which is that it basically asymptotically goes to zero. Here we're looking at it in logarithmic form, and we can still see a very, very clear trend downward in the purchasing power of the dollar. Well, this is by design, and in fact, it must continue to happen. And we'll get into why in a second. But I want to point out many people are probably noticing a notable exception. Well, the period of time from, say, 1928 up through 1934, the purchasing power of the dollar actually rose by about 38%. So your dollar that you earned last year and you put under your mattress would buy you 38% more goods and services. This is the exact opposite of kind of what most people know. I want to point out that was the Great Depression, and government debt to GDP, as we will see in a second, very, very important factor. Government debt to GDP was only 16%, and household debt to GDP was only 35%. So many people, unfortunately, over the past 5 years, have had an introduction to inflation. Well, a lot of people will see or be familiar with the year-over-year rate of change of inflation, right? Right now, it's running at 2.9%. But really, what this is measuring is the rate of change of an underlying index. This is how consumers and the average American feel inflation, which is a cumulative rise in prices or cumulative decline in the purchasing power of the dollar. They do not feel it. Oh, prices are going up 9%, but thank goodness they're only going up 2.9%. They've been going up the entire time. So average Americans feel inflation this way, which is a cumulative rise of prices of goods and services. Economists refer to inflation this way, as a rate of change of this underlying index, usually year over year. And I want to point out, again, going back to that Great Depression, at the peak here, cost of goods and services was declining by 10% per year. But of course, this was not possible with GDP plummeting and deflation. You had to offset it somehow. Well, back then we were on the gold standard, where the dollar was actually backed by gold. So what they did from the period of time from 1929 up through 1934, we can see they devalued the dollar. Now, what that means is that the gold price in dollar terms in white, which is what we're looking at there, the gold price went up by 68%. But the other way to think about that, the inverse of that, is, of course, the dollar denominated in gold. The dollar got massively devalued by about 68% to try to offset some of the economic carnage that the Great Depression was. So here we're looking at household debt to GDP and government debt to GDP. So I pointed out in that first slide, Great Depression, government debt to GDP was 16%. That's not even on this chart. That is so far below any recent reading that's not even on the chart. Household debt to GDP we see in white, and blue is government debt to GDP. What I want to point out is this major turning point here of the GFC. So after .com, of course, that was an equity or stock market bubble. After then, there were public statements from policymakers on the need to blow a housing bubble. Well, sure enough, they did through subsidized demand, among other things. They blew a housing bubble, and of course, that popped in 2008 with the GFC. Well, there is nothing really larger that you can blow in terms of a bubble to absorb the losses from, of course, the equity bubble in .com, and then, of course, the massive housing bubble in 2008. So the government had to step in. Luke Gromen always points out, they blew an equity bubble. They kicked that upstairs to a housing bubble. Well, after the housing bubble, there's nothing left to blow except a sovereign debt bubble. And so we can see that government debt to GDP has doubled from 62% to 124%. Now, households have actually delevered, as we can see, from about 99% down to about 68%. So this is why it can't be allowed. So here we're going back to the Great Depression. We're looking at government revenue and government spending. This is a logarithmic chart, by the way. From 1929 to 1933, revenue declined for the government declined by 50%. Spending, on the other hand, increased by 50%. So the deficit got significantly worse. GDP, on the other hand, or the economic output of the US economy, declined by 45%. Well, current spending is about $7 trillion per year. Current revenue is about $5 trillion per year. Therefore, the current deficit is about $2 trillion per year. Remember, what that means is that every year, just to survive, we have to issue $2 trillion of new debt just to kind of get by. That is what that means. Right now, it represents about 7% of US GDP. Now, assuming this Great Depression 2.0 that so many are so convinced is going to happen in the next year or two, here's what would happen. If it's a Great Depression 2.0, new revenue would be 2.5 trillion. And spending would be $10.5 trillion per year. Again, assuming it's a Great Depression 2.0, which is what so many people are saying, the new deficit, annual deficit for the government would be $8 trillion per year. Now, even assuming this is, of course, the Great Depression using the metrics from the Great Depression, but even assuming just the past couple recessions, our deficit on average would increase to about 15 or 16% of GDP and would represent in nominal terms about $5 trillion. But wait, it actually gets worse. So GDP plummeted during the Great Depression. Currently, our GDP is about $30 trillion. The new GDP would be $17 trillion. Again, assuming a Great Depression 2.0. The new deficit, which we established, is $8 trillion, a 4x from where we are now. The deficit as a share of GDP would actually be close to 50%, meaning every single year, half of the economic output is issued in new debt, in addition to whatever debt must be rolled over. So here is 2008. This is one that many people will remember. We did actually get some deflation, not nearly as much as the Great Depression, but I wanted to go over kind of why deflation would be so terminal given the highly levered debt-based monetary system that we live in. So, for example, in a recession, certainly in a depression, all of the debt, which is money in a debt-based system, all of the debt, for example, a $100,000 loan, well, that $100,000 debt stays the same. It doesn't go down. It is still $100,000, but incomes are falling. Here, by the way, we can see in 2008, personal income declined by 7%. Now, home prices declined by 20%. The S&P 500 declined by 45%. So assets are crashing, whether that be homes or stocks. This, of course, if it was bought on leverage, could result in a margin call or bankruptcy, which is a margin call, remember, is forced selling. If you cannot come up with the money to maintain your margin, you get liquidated. It is forced selling. Well, of course, that only puts more downward pressure on the asset. Banks start to fail from defaults, right? That $100,000 loan that you owe to the debt that you owe to the bank. Well, your income is falling. The unemployment rate went from about 4% up to almost 10%. So you don't have a job, or if you do, your income is falling probably. You're getting pay cuts. So you can't pay back that $100,000 loan. So the banks start to fail from all of these waves of people defaulting, whether it be an individual or a corporation. Well, as the banks are starting to get stressed from a income perspective, they stop lending into the new economy. Well, remember, in a debt-based monetary system, you must have that increase in debt. That new private credit creation is the money. So as the banks stop lending into the economy, the money just completely freezes and might even go negative if there's, again, deflation and a wave of defaults. You might even have the money supply shrinking. So that only amplifies the recession into a depression. And by the way, as we just saw, the government can't tax enough in a shrinking economy, and their deficit would go to basically 50% of GDP. You are full-blown emerging market at that point, printing the money, monetizing the debt directly. So I'd mentioned that private banks must always be loaning money into existence. Well, why is that? Well, about 90% of the total money in the system came from a private bank. It was printed by a private bank. Here we can see M2 broad money supply and total bank credit. Remember, one man's credit is another man's debt. As we can see, the 12-month rate of change of the money supply is about 5%, meaning the broader money supply is growing at 5% year over year. So remember, when they tell you inflation is 2.9%, remember that metric. Now, the 10-year average for M2 growth is 6.5%. That is over the past 10 years. If we look at bank credit creation, that's running at about 5.5%. Very, very similar to, of course, M2. Now, so if the private banks stop lending and if there's this kind of cascading effect where people are losing their jobs, so they have no income, businesses are losing out on income, they can't pay back their loans. We established, especially when it comes to the government, there's an insane amount of leverage in the system. Banks are levered by about 10 to 1, right? There's so much leverage in the system that as soon as the economy stops growing, you lead to this cascade effect. So what happened after 2008? Here's a number of ways of thinking about it. So we have the M2 money supply as a share of GDP. M0, this is that government or official money created by the Fed or created by the Treasury, currency plus bank reserves, is M0. M2 is more that private bank side of the money creation, much more broad way of measuring the money supply. Then we have the Federal Reserve balance sheet in green. And then we have M0 money as a share of M2. And what I want to point out is that that was relatively constant, as was M2 as a share of GDP, as was M0 as a share of GDP. It was relatively constant from the late 1960s all the way up until the GFC in 2008. Well, what happened then? Again, they had blown an equity bubble here. They kicked that upstairs, as Luke Groman says, to the housing market, blew a housing bubble. Well, there was nothing left to blow except a sovereign bubble. So what we're looking at here is that sovereign bubble, whether it be the Fed balance sheet, whether it be M0 as a share of M2, which, by the way, before 2008, this was about 11% of the M2, the broad money supply, was M0, which is that official government money. Now it is 26%. Same thing, by the way, if you look at Fed balance sheet as a share of GDP, that about 3x'd from 2007 up until now. So what we're seeing here is the government stepping in to prevent any sort of deflation, to prevent any sort of cascading default cycle that, again, leads to the banks stepping back from lending into the economy. Well, again, the economy must always grow. If it stops growing, the entire system falls apart. We have a debt-based monetary system. So if the debt stops expanding, the money stops expanding. And you start to get into, again, that cascading effect of deflation. And I just wanted to point out, a lot of people are drawing parallels to 1929 when it comes to the stock market. So I wanted to throw this slide on just to finish up here. Right now, the value of equities or stocks held by households is about $51 trillion, according to the Federal Reserve. Equity stocks as a share of total financial assets is about 45%, which is, by the way, the highest on record. Margin, which is, again, that debt that is built up in the equity market where you put up $100 and the broker says, okay, we'll give you another $50 to trade with. So now you have $150. That margin debt right now is about $500 billion. So a lot of people are looking at the overvaluation of the stock market, and they're comparing it to 1929. And of course, there are some elements that are similar to 1929, increased speculation, increased risk taking. There are certainly some parallels, but let's take a look at margin debt. So as a share of GDP, it was only now it is only 3.5%. Back then it was 8.1%. So over double margin debt as a share of GDP. If you look at margin as a share of market cap of the equity market, of the stock market, it was 9.3% in 1929. It is only 1.6% now. So when you look at the actual scale and you normalize for inflation, you normalize for the loss of purchasing power, which again gets reflected in financial assets as a store of value. This is part of the reason they look inverse to each other, is because to some degree they are. As the value of the dollar declines, anything denominated in dollars, like the Dow Jones Industrial Average or gold or housing or whatever will go up in price. But again, the government cannot allow a Great Depression 2.0 because it would bankrupt them. If we go back to this slide that shows what it would do to the deficit, it would turn our deficit from 7% of GDP to 45%. So what is that? About a 7x. You are half of your GDP is must be issued in new debt. It is not possible. They will print the money just like they did after the Great Depression, where of course we were on a gold standard, and so the way they did that was by devaluing the dollar. So, anyways, hopefully that was helpful, and I'll catch you in the next one.